So, welcome to the Monkey Stock Club. For those who are new at this channel, my name is Monkey B. I love to go out there and finding some nice stocks just for you. So all you have to do is just watching this video and decide if the following stock could be something for your portfolio. It doesn't get much easier than that. In return to that, please feel free to hit the subscribe button below and become part of the Monkey Stock Club family, so you will never miss a video again. Please be aware that everything I say here is just my opinion, as I'm not a professional investment advisor. As you can see, I'm just a monkey, but nevertheless, I love to analyze stocks just for you. So let's stick around and discuss some numbers now. So to analyzing the stock, I use the high growth investing strategy. It consists of 6 KPIs. For every KPI you can get 0 up to 3 points. So in total, a stock can get a maximum of 18 points, and this indicates a high growth stock. So today we're going to do a comparison between SOLAREDGE versus Canadian Solar. So first of all, I go through the high growth investing analysis of the 6 KPIs that I mentioned before. Afterwards, we do some quantitative analysis strategy based on 6 known KPIs for each of those stocks. And last but not least, we will do the fair value calculation for both companies. And at the end, I will award some of those stocks as a winner. So I'm here today to do my best to explain why I think one of those stocks could be a better opportunity for each of us. And yes, so stick around for this entire video, because I think they could be massive opportunities for you. So let's start it. So I mentioned in the videos before, just take a look into Yahoo Finance and all the figures. To be honest, if you take a look in all these data, it could make somebody crying and not even know where to start. This is what I will do. I will do it as always, and then I will present you the results. So first of all, we start with SOLAREDGE Technologies. They have a closing price of around about 243 US dollars. A very nice price development within 1.5 years, or let's say here since March 2020, so almost 8 months. So they triple the price, so that's quite amazing. And the 6 KPIs here above that you can see are considered the EV divided by the sales, so the enterprise value. So where we find this figure in Yahoo Finance, you can find it on the value measured 7.48. On the next slide decks I will also explain what does this value mean in terms of the points that one stock can get. So SOLAREDGE had 7.48. Then the gross margin is the sales reduced by the direct cost and divided by the sales, 32%, as we took the gross profit, so the divided by the revenue, so then we got the gross margin. The rule of 40 is the sales growth rate, trailing 12 months, plus the free cash flow margin. So here we can take the net income, also the revenue, and as well as the sales growth rate. And if we combine this, then we end up at 31%. The sales growth is 20, so 20 plus 11, we end up at 31, as 175 divided by the 1.52 billion, we end up at around about 11%. The debit ratio 0.6, debit last quarter, equity last quarter. Here we see the equity. It's always important to use the last quarter and the debit as well. So if we make the ratio, then we end up at 0.6, and the price per earnings divided by the gross. Here we have the PE ratio, trailing 12 months, divided by the profit growth, trailing 12 months, then we end up at 14.8 as a ratio. Next one. The second one is the quantitative analysis strategy, as I mentioned before. Here you can see also some screenshots from Yahoo Finance. So the return on equity you will find directly within the management efficiencies. The EBIT margin, EBIT divided by revenue, around about 15% as a ratio of the EBITDA and the revenue. The equity ratio divided by the total capital, you can see as well in the balance sheet. So if we take the share price divided by the EPS, the average EPS, then we end up at 85 roundabout. The current PE ratio, share price divided by the current EPS, so we got the 3.36, so then we end up at around about 72%. And last but not least, the profit growth, the EPS next fiscal year to this fiscal year, all measures are estimations, so 14.5%. So just to give you an idea where all the data are coming from, so we have already the results of the 6 KPIs for the high growth investing analysis, as well as the quantitative analysis strategy based on the 6 KPIs for SOLAREDGE. So next one, Canadian Solar, lower price of around about $38. They dropped after releasing the, from my point of view, quite good Q3 results. I think it could be an interesting opportunity to invest into this stock. So the enterprise value divided by the sales, you can get directly as well from the value measures of Yahoo Finance, as you can see here. The cross margin 2023, as we use the gross profit and the revenue. The rule of 40 is the combination of the sales growth rate of 0.35. So I didn't found the trailing 12 months sales growth, so that was the value I found, plus the free cash flow margin trailing 12 months if we use the ratio of the net income divided by the revenue, then we end up at around about 8%. The debit ratio last quarter divided by the equity last quarter 1.74, and the PE divided by the gross profit growth, we end up at 0.47 as we use the PE ratio trailing 12 months of 9. That's quite a nice value, divided by the profit growth of around about 20%, so we end up at 0.47. Also very nice development in terms of the price, also 16th of March, $14.7 US, and currently we going up to $38 US roundabout. The second analysis we use to rate Canadian Solar and compare it to the competitor SOLAREDGE is the quantitative analysis strategy. Return on equity, as you can see here, and management efficiency. The EBIT margin, you can use the ratio and end up at 17%. The equity ratio is the ratio of the equity to the total capital. You can see in the balance sheet, 25%. The PE ratio 5 years, 12, around about 12. Current PE ratio 9.12, and the profit growth is around about 20%. So that's the hard work to do, and now we go through every KPI of the high growth investing analysis and compare it to each other. So here on the left hand side we see SOLAREDGE, and on the right hand side we see Canadian Solar. So the enterprise value divided by sales. In general, the enterprise value is a measure of the value of a company regardless of its financing, and if you divided the enterprise value by sales, you can get an important ratio for the estimating the valuation of a fast-growing but still loss-making technology company. So here we have for SOLAREDGE, as I mentioned before, 7.48. We can took all the data from Yahoo Finance, compared to Canadian Solar 1.25. Both companies get 3 points as we are below 8, but as you can see here, we could give Canadian Solar under the circumstances an additional plus due to the fact that they are quite lower than the EPS divided by sales from SOLAREDGE. Nevertheless, both get 3 points. So here you can see the maximum high growth investing score, 3 points, a maximum for each KPI, and the first 3 points for SOLAREDGE as well as for Canadian Solar. Next one is the gross margin. The gross margin provides us a good indicator of the profitability of a business model, and the higher the percentage, the more money a company has available for sales, marketing, research and development of other products, for example. So here SOLAREDGE is doing quite a little bit better, of around about 9%, so 32 compared to 23%. Both are below 50, so both companies are getting 0 points for the gross margin, so still 3 for each of the companies. Next one is the rule of 40. So the rule of 40 is a simple key figure to assessing the efficiency of a company, growth and the quality of its business model. And the higher the value, the better the company's business model is, and everything above 40 could be considered as attractive. Here we have 31% below 40 and 8%, so both are getting 0 points. Nevertheless, SOLAREDGE is doing better. Next one is the sales growth trailing 12 months, so 20% for SOLAREDGE and 0.35 for Canadian Solar. SOLAREDGE was around about 20%. They get 1 point as they are equal 20. So 1 additional point for SOLAREDGE. So in total they have currently 4 points compared to Canadian Solar with 3 points. Next one is the debit ratio. The debit ratio gives us information about the debit and about the risk from debit. So everything less than 1 indicates a low debit, while a debit greater than 2 indicates a possible risk for debit. So here we have for SOLAREDGE 0.65, so they are getting 2 points as they are between 0.5 and 1. Unfortunately, Canadian Solar is not doing so well in terms of the debit. Not a big risk, as we are not reaching 2, but we need to take a look into it in the future. Last but not least, for the high growth investing analysis, the PEG trailing 12 months. So this is one of the most important key figure for the assessment of an already profitable growth stock. And if the ratio is between 0 and 1, we can talk about an undervaluation of a company. And as Peter Lunch already mentioned in his formula, and as we can see here, Canadian Solar has reached 0.47, so they are below 1. Quite good value, so we could assume that Canadian Solar is currently undervaluated, as SOLAREDGE is bigger than 4, so we don't get any further points for SOLAREDGE, and from my point of view they already reached the fair value. So overall, both companies are getting 6 points in terms of the high growth investing analysis. So next one is the quantitative analysis strategy. We collected all the data for the KPIs for the 6 ones. So the first one is the return on equity. It indicates how the equity of a company has earned interest during a financial period. A shareholder can see from the return of equity how profitable his investment in the company is. So we have around about 20% for SOLAREDGE and around about 18% for Canadian Solar. So quite comparable in terms of the return on equity. Unfortunately, both of them are getting 0 points, as they are between 10 and 20. And one additional remark to this analysis: you can get for every KPI 1 on 1 point or a minus point, or 0 points. So that means a maximum of 6 points can achieved, but as well as minus 6 points can achieved as well. So both companies are getting 0 points, as they are between 10 and 20%. Next one is the EBIT margin. High EBIT margins are a quality criteria for the investment risk. So the higher the EBIT margin, the easier it is to manage declining sales. So they are doing quite similar, so 15% for SOLAREDGE and 17% for Canadian Solar. So both companies are getting 1 point, as they are above 12%, so quite nice. Next one is the equity ratio. Provides us an information about the credit rating of a company. So both companies are doing quite well. So the equity ratio of SOLAREDGE is very high, 54%, as Canadian Solar has around about half of the percentage, 25%. Nevertheless, both companies are getting 1 additional point, so both companies have 2 points, 1 for the EBIT ratio and 1 for the equity ratio. Next one is the PE ratio, 5 years. So this indicates after how many years you have doubled your stake. So assuming that the profit remains constant. So it could be therefore a good indicator of whether a share is expensive or cheap. So for SOLAREDGE, 85.61. If we calculate the ratio of the share price divided by the average EPS of the last 5 years, and Canadian Solar has reached around about 12, So in this case, 11.81 is between 0 and 12, so Canadian Solar gets 1 additional point. And as I mentioned before, within the quantitative analysis, you can also get minus points. So 85 is a very, very high value. So that means you need a lot of time to double your stake. And you got here under these circumstances a minus point, as we are farly above 16 as a point. So 1 minus point we need to remind to calculate then overall the final result. Next one, the current PE ratio, 72, so you take the share price divided by the current EPS, so 72, compared to the Canadian Solar 9.12, so we got 1 further additional point for Canadian Solar for the current PE ratio, and 1 additional minus point as we are farly above or highly above 16. So last but not least, the profit growth. We use the estimated EPS for this and next fiscal year and do the ratio, and the percentage gives us then the indication of the profit growth. So for SOLAREDGE, 14.5% as we compared this to the next fiscal year's EPS, and 20.28% for Canadian Solar. So both companies are doing quite well in terms of the profit growth, as they are above 5%. Both of the companies are getting 1 further additional point, so 1 point for SOLAREDGE and 1 additional point for Canadian Solar. So that's finally the last KPI for the quantitative analysis strategy. So in total, SOLAREDGE are getting 1 point, as we have 1.4 EBIT margin, 1 for the equity ratio, and 1 for the profit growth. But for the PE ratio, 5 years and current PE, we got 1 minus point, so it reduced the 3 points by -2. We got in total 1 point. Canadian Solar are doing quite better, overall 5 points, no minus points, so in total as a sum 5 points compared to 1 point in terms of the quantitative analysis strategy. So here the overall result within the high growth investing strategy. Both companies have 6 points in terms of a high growth stock out of 18 points, so they are quite similar. The opposite of SOLAREDGE is that they are doing quite well in the enterprise value divided by the sales, as well as by the sales growth and debit ratio. Canadian Solar are doing also quite well in terms of the EVS divided by the sales and PEG. That is why they also got in the other analysis, the quantitative strategy analysis, better points in the PE ratio. And here we can see, in addition to that, that they are highly undervalued. So 6 points, quite comparable, both companies, in terms of the max quantity score. So maximum of 6 points can achieved for each KPI 1 point, and as I mentioned, 2 minus points for the PE ratio, 5 years and current one. So overall, SOLAREDGE get 1 point and Canadian Solar 5. So if we combine both strategies, Canadian Solar got 11 points versus 7 points. So Canadian Solar are doing better than SOLAREDGE. And last but not least, finally, we do also the fair price evaluation. So what is the fair price? We use the Peter Wunsch formula, EPS multiplied by the profit growth. So what I did is I take a look into the EPS of 2017 of SolarEdge, 1.85, compared to the estimation of 4.58. So we have an average profit growth rate over the years of 62%. So 62% multiplied by 4.58, we end up at $284. Compared to the current price of 244, we have an let's say a gap of 16%. So quite a little bit potential for further price increase to reach the fair value. So, but as I mentioned, and this shows also the PE ratio and the PEG ratio, that they reached already the fair price. If we take a look into Canadian Solar, EPS 2017 of 1.71, if we do the ratio to the next fiscal year estimation of 3.38, we end up average profit growth of around about 50%. And if we multiply this by the estimated, or let's say by the current one, we end up at around about 140. So that's a gap of around about 368%. What is the storyline behind it? We can see that currently, if we combine it or compare it to the current price of $38, and if we just use the 2.81 EPS for this fiscal year estimation and not the 3.38, we already end up at $140, and that's a massive potential. So 368 is quite huge. So yeah, so the next one is the big question: who's the winner? It's clear. If we compare Canadian Solar to SolarEdge in terms of the high growth score, both companies are getting 6 points. In terms of the quantitative analysis of the 6 KPIs, SolarEdge got just 1 point out of 6, and Canadian Solar 5 out of 6. So in total 11 versus 7 points. And yeah, the winner is Canadian Solar. If we also take a look into the potential of the undervaluation that we have within the Canadian Solar stock, I would highly recommend to invest in Canadian Solar instead of SolarEdge. But to be honest, SolarEdge is also a very nice company. But if we compare both companies just on key figures, Canadian Solar are looking quite interesting. So yeah, that's all from my side. I hope you enjoyed the video. Push the like button for the YouTube algorithm, and I would also really appreciate if you would hit the subscribe button below and become part of the Monkey Stock Club family, so you will never miss a video again, and it helps me to go ahead and producing nice videos with nice informations. And as you saw, I do the lazy work, collecting all the data from the internet and showing you the overall results. So then, have a nice day. Bye bye.